In this video, I want to talk about the Warren Buffett framework I use to analyze any business when I'm faced with a company to analyze. What are the filters I use? What are the metrics I monitor to know if I want to buy, if I want to put it on the watch list, or do I want to sell or just dismiss the investment idea? In this video, I will tell you the step-by-step process so you can be faster in your analysis and you can utilize this framework. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing the Warren Buffett way. Okay, so I go through specific filters. The first one being the first simple. I know that I don't know everything. You want to stay inside your circle of competence, obviously, which means you don't want to play smart. You don't want to sound smart. You want to invest in things that you can understand. So, do I understand the business model? And it may sound like a vague first point. I agree with you. But the reality is, can you explain the investment idea to a child in 30 seconds? Can you go to the annual report and know what is important? Can you go through the slide decks, the investor presentations, and know what is the DNA of the company? When we talk about circle of competence, it's very easy to say. It's much harder to implement. This is something I've been working with my students inside my coaching program. Some things that can be pretty helpful is when you are faced with a new business, okay, a new company, a new stock, you can go to the investor presentation, the latest investor day presentation, like 100 slides, for example, and you try to understand what are the priorities of the management team. This is a topic that is rarely discussed on YouTube or on Twitter. Actually, I've seen almost no one mention this. So let me explain. You have a business, a new business, and you will see some slides. The investor day presentations, like 100 slides. What is the tone they use? An optimistic tone? A rational tone? An emotional tone? We are going to save the world tone? What is the tone? What is the DNA of the company? With 100 slides, you can have a pretty good idea whether the management team is very bullish or neutral or pragmatic, or they want to look at the track record or not. For example, do they show slides with a long track record of the revenue for the past 20 years, the margins for the past 20 years? Or do they show you the margin profile for the past 2 years? What is the track record that the company shows? Also, what are the priorities of the management team? What is the tone? What are the words being used? Do they use words like revenue growth, acquisition, aggressive? Or do they talk about efficiency, shareholder returns, return on invested capital, earnings per share? Some companies, I can mention some specific names actually. There is a company called Intuit. In the software department, they do accounting, tax planning, and if you go through their investor presentation, they talk about growth. Sometimes growth at all costs. They talk about achieving a revenue growth rate of 20% per year. They never talk about efficiency. They never talk about a number of shares, shareholder returns. They never talk about margins. They talk about revenue, revenue, revenue. Okay? They talk about their target of growing 20% per year, their revenue, and maybe doing acquisitions to reach their goal of 20% per year. They never talk about efficiency. And there are some other companies, Booking Holdings is a good example. They talk about shareholder returns, efficiency, margins, okay? They talk about growth, but they mostly talk about shareholders, buybacks. So the tone is different between two companies. The first point is circle of competence. Do I understand the business model? It also means, do I understand the vision of the management team? Do I understand the DNA of the business? Is this a business focused on revenue growth at all costs, like Intuit? Or is the management team focused on efficiency and buybacks and shareholders like booking holdings? And depending on your style, what do you want? Do you want to be invested in companies that will grow a lot? Or do you want to be invested in companies that will do buybacks a lot? Depending on your style, okay? No formula is perfect. You have successful investors focus on growth, successful investors focus on buybacks. Choose your team. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. I'm on the camp of buybacks actually. I prefer buybacks. You don't have this execution risk. I can put a small story here because I don't want to invest in companies that are too much focused on growth and only growth, revenue growth at all costs, because you have execution risk. They may have a stupid acquisition. What if the acquisition fails? You are doing an acquisition to grow your revenue, okay? But what if the execution is bad? What if you don't have the synergies you expect? And I don't like this risk. For buybacks, I think you have a minimal risk. So that was for the first point, the Warren Buffett framework. First of all, understanding the vision of the management team. Understanding if you understand the business model in reality. You go through the slides, annual report, see if you understand in simple words the business model. See if you can pitch the idea to a child. Second point, metrics. You want to talk about the fundamentals. So you want profitability, which means you will never touch businesses that are unprofitable. Never. That's it. You can just dismiss them as soon as possible. I think I've never invested in companies that were unprofitable. I like cash flows. I like earnings. It's much easier to value businesses that are profitable. So you want to only touch businesses that are profitable. Second of all, you want cash flows, a focus on cash flows. That could be important. You can add back SBC. Some companies are different. You have different accounting treatments. But anyway, you want profitability and cash flows and growth. Okay? Not all stocks, not all companies will be growing cash flows. Over the past 10 years, 20 years, you want a good track record of profitable growth. Profitability, cash flows, growth. Also, you want efficiency, meaning you want improving margins over time. This is a point I've been using for a while, and it's extremely important. You can invest in a profitable business, but if the profitability is declining, that's not good. It means the moat is eroding. The competitive advantage is getting weaker and weaker and weaker. You don't want this. You want to invest in companies that are getting better over time, right? Growing more efficiency, better margins, wider moat. So you want improving margins. And I can also mention another metric is improving return on invested capital, ROIC, over time. Okay? So better margins, better ROIC. Now, just based on these 3 points, you will dismiss 90% of the companies. If I encounter a business that is not focused on growing margins, I'm out. If I find a business that is not focused on growing cash flows, I'm out. These are hard filters. So just based on these 3 filters, I can dismiss more than 90% of the stocks. And what is remaining is the 10% golden ideas. The fourth criteria is the valuation. Obviously, you don't want to invest in companies with a very high PE ratio or high price to free cash flow. You want to play around with a DCF, a discounted cash flow model, to really forecast the cash flows in the future, have a clear discount rate, and find an intrinsic value. Best case scenario, for the valuation part, you will find a margin of safety, meaning you find an intrinsic value of $100 and you buy at a stock price of, I don't know, $70. So you have a small margin of safety. Not all businesses will have a margin of safety. The wider the moat, the minimal the margin of safety, I would say. For spectacular businesses like Visa or MasterCard, it will be pretty difficult to find a margin of safety. You will very rarely find these stocks trading at a PE of 12. Very few times in history you had this. But for other businesses, you can sometimes find golden opportunities of an excellent business model available at a discount compared to the past, where the intrinsic value is higher, so you have a margin of safety. And this last filter will go from 10% of what was remaining to top 1%. So these 4 filters will remove 99% of the businesses. The first 3 filters will remove the majority of the stocks you will encounter. And for the valuation part, what is cheap or fair value I am buying, okay? And I am building my portfolio based on this valuation framework. And when the stock is too expensive, I'm putting the stock on my watch list, okay? So I can monitor it over time. And when the stock drops, I can buy in the future, in the next 3 months, 6 months, 1 year, 2 years, 3 years. The watch list I have right now is more than 100 stocks. So I am monitoring a lot of stocks that I don't have in my portfolio, but this game is about patience. Investing is about temperament and patience. Sometimes you are doing the heavy lifting, you're doing a lot of research, a lot of work, and you wait because the price is too high, the valuation is too high. So you wait. And for those who are patient enough, when the stock is dropping and you are prepared, you can buy at a discount. And this is where you can find wonderful opportunities in the long term. So this is the clear Warren Buffett framework I've been using to analyze any business, and it is the framework I use to beat the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn my strategy to generate 25% annual returns. You will learn how to find winning opportunities. You will learn how to properly value any stock, when to buy, when to sell, so that you can build a strong portfolio filled with great companies. Additionally, inside this coaching program, you will have access to an exclusive community of like-minded investors, and also you will have my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need for your email address, just click the link in the description and I'll see you on the other side.